Okay, welcome to the March 2023 edition of the ASIS Economist Board. I'm John Nelson from M&A, and I'm joined today by Keith Prater of Armada. How are you doing today, Keith?
Doing fantastic. Fantastic. Ready to talk manufacturing.
Outstanding. Okay, in this video, for you guys who have not been with us before and in the related subsector videos, we're going to dive into what's driving each of our forecasting models and related to what we're seeing in the real world. And more importantly, where things are headed and why. Not just a history report, but looking forward. Each of our industrial models looks at approximately 18 to 20 economic indices with data going back over 20 years. And speaking of data, it's been a real interesting time, both manufacturing and broader economy, hasn't it, Keith?
Yeah, it is kind of interesting because you and I were talking off camera about the models themselves and how they're trying to, keep pace with what's going on in the global economy. And there's just some interesting data points out there because, when we look at like manufacturing PMIs and manufacturing data, like monthly surveys of manufacturing, they're pretty weak around the world. We still have 19 to 20 different countries in contraction, yet you and I have been talking, there's some weird little cross currents starting to happen. The Baltic Dry Index, which measures the input of raw materials into the manufacturing process, has suddenly surged. It's now up like 60% just in the last 30 days. Yeah. So someone around the world is moving raw materials to start the manufacturing process. But I think what we're going to see when we go through the models and look at those is that we're not predicting a big upturn in manufacturing activity in the U.S. yet. Models aren't seeing it yet, but there's a lot of volatility in the data, and I know the models are grappling with just trying to process it and trying to figure it out. But that kind of brings up something you and I were talking about, which is the accuracy of the models. And so maybe we can show folks kind of where we are, at least from a performance perspective, so that they can see, how it is performing.
Sure, we'll open that up. This is where we are right now. The 1 and 3 month look, we're nailing it pretty well across the board. And I would think at the 6 months, we're doing really pretty good with the exception of 2 commodities. And they've traditionally been some of the hardest things for us to predict. And that is fabricated metal and primary metal. They traditionally go through a lot of fluctuation, and you'll even see a lot of volatility in how it actually pans out in the future.
Yeah, and you and I personally set a goal. We'd love to see like a 9 handle. We'd like to see all of our performances up in the 90% range. We really shoot for about 95% or higher. So when we see an 86, you and I don't feel good about our 87, but I do know that we look at these in the most realistic, most brutal way when it comes to scoring ourselves. So 6 months ago, if we said one of the indexes was going to be 102.1, we look and we hit on all these metrics within 93, 94% of that measure. So again, a lot of people I know use the ASIS for these big, broad swings and cycles so they can understand 3 to 6 to 9 months out when they're going to see a cycle change, when we go from a trough to a growth rate, or when we go from a peak to a little bit of a decline. And so I just want to talk about that because we do have, as you said, those 2 sectors where we're seeing a little bit of volatility. And that becomes very germane, I think, when we start talking about, we start looking at those particular models, which we're going to do right now.
Sure thing. Okay, so let's dig in then. Let's take a look at what we're talking about, IP Man, top level index. And what you're seeing, again, I like to focus folks on that first 12-month period. And the first 12-month period is telling fairly close to the same story, maybe a little less optimistic than what it was last month. But still, you've got a bit of a trough coming on for the next several months. And it's going to tail off there towards the end. I wouldn't be surprised to see if it picks up, in response to what you were saying with the Baltic Dry Index here in a few months as more data comes in. But for the this next 6 to 12 months, I'm not surprised to see it dropping.
Yeah, and this is a little bit of a change in the way we're showing the data too. So thank you for putting the quarterly change and the year-over-year change down at the bottom. But we can see, starting in Q2, Q3, Q4, that we're looking at what we would consider to be a contractionary period or almost a recessionary period. Q1 kind of as expected, came in, not hot, but I mean, we are seeing a little bit of moderate growth, across the sector, but then the rest of the year is going to be pretty weak, kind of contracting at about 3% for the full year. So there's still some weakness in this. We would consider this, John, to be more of what we call a shallow or a soft landing, in the sense that, you're not talking about deep contraction of 5 and 6 or 7% in the industry. We're still calling it a fairly shallow contraction in each of these quarters. And I think if you're a subscriber, or if you're in the trial and you see the other videos and you look at the other models, you'll see that out of the 8 that we do, a few of them are negative, but the majority of them are showing some positive growth on the back end of this curve. And I'm not talking about the 18-month end of it, but as we kind of get into the back end of 2023 and early into 2024, you're seeing some nice recovery in some of the models. So this one, though, overall fabricated metals, overall industrial production and manufacturing, which includes both durable and non-durables, still, again, trying to show some solid stability, but we have a little bit of weakness here. And the one last thing
I do like to mention, though, Keith, you're talking about that weakness. I always talk about scale, and I'll mention this in the other videos as well, but what kind of contraction are we talking about? So if you look at where we are sitting right now, very close to about 101, and that contraction takes us down to, maybe about 97-ish at its lowest point, 12 months out, and then again around 18 months out. I mean, we're not talking a huge drop, about 4%.
Yeah, and that's what it's predicting. And then look at the upper band there, the upper band, and I could also be, negative Nancy and talk about the lower end, but the upper end of that band kind of suggests that the model within that 95% confidence level could kind of see a fairly flat environment. So it's leaving room for some of this unexpected surge in activity on a global basis, and seeing it kind of flatten out. I think the next slide, the next chart is one of my favorites, because it kind of gives us that historical perspective.
Yeah, I agree with you on this. And one thing that I always like to focus on is, and it's just from looking at from the analytical side, is just how much does it swing? And are we seeing anything that's swinging greater than what we've seen in the past? Is this an unusual event? Well, what do I mean by an unusual event? Well, look at 2008, look at 2020, clearly unusual events, but the swings right now, it's a little bit larger than the most typical swing that we've seen if we compare it to like the 2018 to 2020 drop, but it's not wildly out of range.
Yeah, no, you're right on. I mean, it is recessionary, but again, probably this is the narrative of that shallow recession. So, if you look at the curve, namely, it does not drop as dramatically as we saw, during the Great Recession, or as we saw in 2020, sorry. But, it does feel a little bit more like the recession that we saw, back around 9/11 in the 2001 period. So it's a little elongated. So the curve itself doesn't just dive. It doesn't feel like it's going off a cliff overnight. It's kind of a slow recession, and then we're starting to get these little hints of a little bit of recovery kind of starting on the back end, although not very strong. So you can tell the models are still struggling to figure out, whether the recovery period can be sustained and whether it can carry through. So still reading a lot of pressure in the model itself. But again, soft contraction, which means some subsectors inside industrial production, across the manufacturing sector, are not going to feel as big a recession as others. There's going to be more dramatic winners and losers, and the whole industry is not going to move together as maybe we would have seen in other recessions.
I do like the year-over-year look. This is one of my least favorite charts in general, but I like this particular one because I think it demonstrates what you're talking about, that soft contraction, fairly well. The dashed red line is our forecast moving forward. And so when you see that, notice you've got it going down, but this is not like a fall off the cliff type of contraction here over the next several months. The second thing I like to point out is that where is it sitting relative to the other years? And it's pretty much crossing multiple of those other years. So it's not getting way out of bounds and falling off the cliff, so to speak.
Yeah, and there is something that the models are watching, that we're watching, or we are watching inventories pretty closely. And one of the things that's really impacting manufacturing sector at the moment, what's really keeping it a little bit weaker than it probably should be, is that companies overbuilt their inventories in 2022. We still have a pretty strong consumer that's out there still spending money, mostly on essential items. So that would be under the non-durables side of this category. But even on the durable side, in automotive and aerospace, some of the machinery categories, computers and electronics, we're starting to see some momentum building. And so it is interesting. And if we didn't have such an inventory overbuilt situation, we would probably have a completely different looking curve, and we'd have a completely different economic outlook. So we're running just that fine a line between expansion and growth and contraction. And I think we can tie it all to how companies are sitting on inventories. And we literally just overbuilt in 2022 just because of the prior 2 years and supply chain congestion and bottlenecks and challenges, and companies, double and triple ordered products and components. And now those orders were largely fulfilled and are still getting fulfilled. But that has just overbuilt inventories. We looked at a piece of analysis the other day that showed that about 70% of the companies in the United States that produce goods or move goods or handle goods are overstocked right now. 70% of the market is sitting in an overstock situation. So that's pretty dramatic. And that's a lot of what I think is driving the weakness in these models.
Well, let's take a look further upstream. In fact, let's go all the way upstream and take a look at the raw materials themselves and primary metals. Again, this is one of those two sectors that you had mentioned that we weren't as accurate as usual, but I also like to take a look at the volatility on this one to kind of maybe give myself a little bit of a buy, if you will. When we take a look at the long term, you'll see it a little bit more. But whereas last month we were kind of looking at almost close to flat, you can see the swings in both the forecasts this month and last month. Last month's forecast being there on the right hand side, but we still have a little bit of overall contraction if you take a look at the long range out there. But about 12 months, you're still looking flat, despite this little bit of about a 5% bump.
Yeah, and I think I'm going to jump away from the model for a second here, and I want to tell a story about what's happening around the world, because I do think it's something we need to watch. And so very quickly, we've talked about it before, but global inventory is a lot of core, raw metals, if you will, copper, aluminum, zinc, lead, nickel. I can go down a list of commodities. If you look at some of the global inventories for those metals, you'll see that they're sitting at multi-decade lows. And they're sitting at multi-decade lows when largely, the China industrial production complex and the European industrial production complex have been somewhat offline. Europe got hit really hard with, energy shortages and skyrocketing energy costs early last winter. And so the first thing to get shut down was industrial production. So they curtailed and pulled back demand. The same thing happened in China as China went through COVID, and the lifting of the zero COVID policy. Suddenly infections of COVID went, and swept throughout the Chinese economy. And just like the rest of us experienced, they had a really rough, tough, 4 or 5 months of just trying to get through infections. Now that they're coming out of that, and now that Europe is coming out of the winter, we're starting to see a new surge in demand. And that new surge in demand just out of those two markets alone, with raw material inventories now worldwide being very low, is creating a really odd mix of things in the model, because we're kind of getting inflationary pressures are starting to pop, but they're bouncing back and forth month over month. And it's just creating a lot of volatility. And I think the model's wrestling with that because general demand metrics are pretty low. But when you look at the supply side, on the primary metal side, we're starting to get that volatility, low inventories, rising demand in some of those markets, pushing prices up a little bit. And the model's wrestling with figuring out, trying to handle that. So being within 87% accuracy 6 months out, still not too bad.
Well, we've been talking a lot about volatility, and here you go. This is the last 20 years. And look at these swings, and they happen just routinely from month to month, and you can see them. And the forecast that we have out there kind of follows that trend line, although it's below the trend line, but it's following the general slope of the trend. But you can see that the swings that we're talking about, this dip that we're talking about, is well in line with what we've seen over the last 20 plus years.
Yeah, not a lot more to add there. Again, the contraction that's predicting is not as dramatic as maybe we've seen in some other periods, but it is still an interesting long-term downward trend starting in about 2011. I will say also, again, when it comes to primary metals, I mean, there is a movement, especially in the federal government, and it's bipartisan, to try and build a lot more resiliency in the U.S. supply chain. And part of that will revolve around primary metals and even rare earths, and trying to secure different inventories for the U.S. and different sourcing partners, if you will. So anyway, I think there's going to be some changes here, but the market hasn't gone through that yet. And so I think over time, I think this industry, this sector will get stronger, and we'll see this 10 or 15-year contraction or this general downtrend like you see in the long-term trend line there. I think will kind of flatten out and improve a little bit as we move some of this a little bit closer to the U.S.
So to understand the next chart, I just want to point out something on this chart. Notice that we were talking contraction, and that goes from here to here. But then notice the short little term rise that we have right here. So the reason I mention that is because when you take a look at the year over year, what you're seeing is not that full 18 months, but like the 12-month look. It only goes out the rest of 2023 on the forecast. And so you're following that dashed forecast line. There's that rise that we're talking about. You start seeing the drop, but you don't see the rest of the drop off. But for the interim time, it doesn't look so bad, at least for the next 12 months. That's a lot of time, as volatile as this sector is. That's a lot of time for the outlook to change.
Yeah, absolutely.
All right, I'd like to move up a little bit closer to the manufacturing. In between primary metals and actually putting the machines together comes fabricated metals. And this outlook also took a little bit of a swing. Luckily took a swing to the positive. And as you can see, it's not a big swing now. If you were to take a look at the scale wise, it's almost flat. We're sitting at about 100 right now. The highest we're going to get is 102 over the next 18 months. But this is time to talk real briefly about how to use the chart a little bit, Keith. We talked about we call it the cone of variability, that wide cone, and how we do that is we run 1,000 simulation runs of the model to see what it looks like, and this is kind of how it produces that width of a cone. So there might be a simulation run that's going to run that high, and so if you compare, it's really instructive to be able to compare the cone this month to where was the forecast of previous month, and you can see that forecast of previous month right there within the cone for this month. So that's one of the ways that we'd like you to take a look at these charts, is to understand in terms of trends what that cone means for you.
Yeah, I love that explanation. That's fantastic. And yeah, so to your point, there was at least a group of simulations there that had this curve as high as 108. So
Yes, sir.
Another way to think about it would be just the model just got a lot more optimistic with the potential upside, because, it was running, right around 98, 99, 98 a month ago on the upper end of that scale, and then popped up. So yeah, so that's kind of exciting. And I think you can see it on the next chart as well. Yeah, exactly.
And here you're definitely rising above that 20-year trend line.
Yeah, that trend line is so important. And you talk a lot about the 10-year trend line. If we were to draw it on this map, it would still be, I think, above that 10-year trend line, because that trend line would run right at about 100, I think.
I think so. Yeah.
Yeah. And so I think the back end, and it's not even the back end of this curve, it's really kind of for the back half of 2023 and then through a lot of 2024. There's a lot of optimism in fabricated metals. And John mentioned it, but I'll just reiterate it one more time. Fabricated metals are key feeder into so many of the other subsectors. So when you go through and you look at the aerospace and automotive industry, machinery, computers, and even in some of the electrical equipment sectors, you're going to see some of what's pushing this curve a little bit higher. So demand in those industries really pushing demand in fabricated metals.
Okay, and then just a year-over-year chart, Keith. I'm not sure that this tells us a whole lot more. You can see the forecast cutting right across the other years, but I think it just really kind of reiterates the same story that we saw in the previous two.
Yeah, and I think on the far end there, that's kind of interesting. And as we get to the end of this year, you can see that it's kind of trending. I mean, I guess it's kind of hanging in there with 2019 and, you know, really kind of 2022, but
Mhm.
you know, potential to be the second strongest year in, you know, this 6-year view that we take a look at.
Got it.
So
All right, well, that concludes our look at fabricated metals, primary metals, but really the overall industrial production. We hope you got something out of it, and then you'll join us again next month.
yeah, and remember, for those of you who are just viewing this and you don't have a trial, the free trial to the ASIS is absolutely risk-free. We don't ask for a credit card or anything, so just go test drive it. After about 60 days, it just goes away on its own if you don't do anything else. So that'd be a good way to see all the subsectors and have access to all the other videos and to be able to dive into some of those, you know, independent components of industrial production. So thanks everybody for joining us. Take care.
Bye-bye.